Imagine you wake up and there's a lotto ticket tagged in. How to use this money to make generational wealth? Stocks. Then you remember? Stocks! But the problem is you don't know much about stocks or shares. Are they different from each other? How to invest? Where to invest? Alright man, stop. Haha. Now let's start from the beginning to understand the stock market. Now let's say Tom started a business alone. That means that he owns 100% of the business. But Tom has one problem. He needs money to scale up the business, to buy cars for deliveries or more computers for more services. We don't know. Only Tom knows. Tom goes to the bank for the loan.
You have been rejected!
But the only way to get money without taking a loan is selling parts of his company to investors. Since Tom sold slices of his company, that means now he doesn't have 100% ownership of the company, which is referred to as selling shares of the company. Haha, that's where you come in as an investor or a trader. Tom is happy to sell part of his company because that will help the growth of the business. And investors are happy to invest because they are confident about the future of the business. In the olden days, only the rich could trade in the stock market. You are lucky.
What a joker!
Because nowadays, everybody could become an investor or a trader. So a share is simply a piece of the company. That's all. Now Tom, the business owner, has two ways to sell the shares. First option is to go to a venture capitalist. To keep things simple, he can go to a private company to sell the shares. The second option is selling shares to the public for everyone to invest. But there's still one problem with this method. Tom needs to make an X amount of money every year, depending on which country you're in, to be granted an initial public offering, known as an IPO. What is an IPO, you might be wondering? The IPO is granted by the government based on the financial records. It gives the company access to raise money by allowing everyone to invest in the company. And this is why we have something called the stock market.
Seriously.
Yeah.
What is a stock market? The stock market is a platform where everyone can buy or sell shares of any company listed on the stock market. This includes the most well-known companies like Apple, Google, and Microsoft. Stocks and shares refer to the same thing. The minor distinction between the stocks and shares is usually overlooked, and it has more to do with syntax, or we can say wording, than financial or legal accuracy. Now, why we do buy shares?
Duh.
To make money. The simple idea behind shares is that you invest in the company because you believe that in the future it will be worth more money. Let's make an example. Let's say you invest $1,000 in Tom's company and the total company value is $100,000, which means that you own 1% of the company. 10 years later, Tom's company is worth $50 million, so that means that now you own $500,000 worth of stocks. But it's important to say that if the company is worth less than $100,000 in the future, that means that you are losing money. The basic idea in the stock is to buy when the price is low and to sell when the price is high. The difference between your buy and sell is a profit or loss.
What changes the price of the stock market? Market.
Supply and demand. You buy stocks based on the market price for that company. If more people believe in the company, there is going to be a higher demand and less supply for the stock, raising its price because more people want it. Let's make an example. Let's say you buy stocks from Tom's company. 2 weeks later, the company releases financial records and they are making profits from month to month because they release a new tech that is ahead of the competition. The company is growing fast and you are making more money. Would you sell the stock? Chances are you will keep them, but more people want them because the company is making more money for investors. If there are more sellers than buyers, the stock price decreases because there is more supply for the stock than demand. Let's make another example. You own X number of shares in Tom's company. Then you hear in the news that Tom's company is using kids as workers and underpay them, or Tom's company is laundering money for drug dealers. Will you want to be part of that? What are the chances that you will sell your stock? I'm guessing high chances. So we can conclude that news, financial records, and laws can affect the company negatively or positively. There are other factors. These are not the only ones.
How to buy stocks. Stocks.
Ten years later.
Firstly, there are so many stock market exchanges. The most popular ones are New York Stock Exchange, Nasdaq, London Stock Exchange, and Japan Exchange Group. The biggest one are as follows. This was important in the past because the investor had to go to the direct building of the stock exchange to buy stocks and get physical stock certificates. It is nice to say that today you can purchase stocks sitting at home comfortably. You don't need to talk to anyone, no need to travel long distances, and the best part of all, you can trade in any of the stock exchanges you like. All you need is knowledge and money to begin. To place your first trade, you will need a trading platform, which can be a website or an app. Examples of trading platforms or stockbrokers are TD, Ameritrade, Robinhood, and many others. What is even nicer is that they are free. Some brokers will even give you stocks for registering. The platforms might be slightly different from each other, but the main features are the same. Now, when you open the platform, let's say you want to buy Google stocks, you won't find them. Because some companies have a parent company, meaning Google is under that company. Google's parent company is called Alphabet Inc. Another example is Facebook. Its parent company is Meta Inc. So this means that if you want to trade Google stock, search Alphabet Inc. For Facebook stock, search Meta. Another important thing is that stocks are in abbreviation. For example, Google stock is GOOGL, Go, and Tesla Inc. is TSLA. This is called stock symbol or ticker symbol. When you click the specific stock, there is going to be a graph that shows how the stock has been performing over time. You can also change the time from weeks to months or even years. How is this helpful? This gives you the ability to analyze the company performance, so you can know if it's seasonal, when it makes most of its profits per annum, or losses. Who knows? What are the factors affecting the company? When you're about to place an order, you will notice that there will be a buy option, and for people who already have the shares in the company, there will be a sell option. After then, you will be asked how many shares you want to buy. What order do you want to buy them? Current market order. Current market order means you want to buy shares at a given price of the shares immediately. Or limit order. Limit order means that you want to buy shares at a specific price, and you can also set at how much you want to sell them. For example, let's say you want to buy shares at $5 each, but you want to sell them at $15 each. So the computer will sell them automatically when that target is reached without your presence. Voila, profits automatic. But the problem with this method is that if the target is not reached, you won't be able to sell.
The odds of profits in the stock market. Got it?
In the stock market, there are two different types of traders, day trader and a long-term trader. A day trader buys and sells in a short space of time. It can be minutes or hours. Most people don't know that being a day trader is very risky with high reward. It demands very high skills and a person who does not only trade but lives and breathes the market. Most day traders lose money. The stats show that 80% of day traders quit within 2 years of day trading and only 1% is successful. This is really for OGs. You don't need to put so much pressure on yourself, especially if you are still busy with other things in your life. One of the best day traders is Jesse Livermore. He is known for high gains and high losses. He made $100 million in a short space of time. However, he lost his fortune and traded it to his own life. Long-term traders are people who believe in specific companies that they will grow in the future. They buy shares and hold them for months or even years, but this takes time and knowledge about company. One of the best long-term traders is billionaire Warren Buffett. But it is important to say that the reason why he's so successful is that he deeply researched companies' financial records and invested in companies he felt like are undervalued. But for an average person, this researching and analyzing is difficult, time-consuming, and what's even worse is that you compete with big hedge funds that have professional analysts working full-time to find new companies to invest in. That is why most people get stockbrokers, but this is still very risky and even cost you money. But there is something most people are not familiar with that I promise can make money for you, and that is an index fund. What is an index fund? Instead of spending time analyzing specific companies, something you are not even good at, you can just invest in different companies in one trade. An example of an index fund is an S&P 500. which tracks 500 public companies. So if you buy one share of the S&P 500, it means that you are investing all these 500 companies in one trade. Another example of an index fund is Nasdaq 100, which tracks 100 biggest companies in the US like Microsoft, Apple, Tesla, and But why you would buy an index fund share than investing in specific company? Because it is very reliable. Because most of the time it is growing, has constant profits, and less risk of losing money. Only happens once in many years because of events like wars and disease outbreaks such as COVID-19. These factors are very rare. But index fund also has disadvantages like lower return. On average, index fund like S&P 500 has a return of about 6 to 10% profits a year. But this is way better than the bank investment that gives you sometimes even less than 1% profits per annum. With long-term investing, starting at a young age is very important because the money compounds over time. If you invest $100, it will make, let's say, $8 in that year. In the second year, 100 will make $8 and $8 make $0.64 or 64 pennies. This will happen over and over. It's a very good choice to grow money, but it all comes down to preference. If you have no problem losing all your money today, you can be a day trader. But also the rewards are very high as you can double your money in minutes. Investing in specific companies also has higher returns than an index fund. It is all about risk and reward, but I still think and believe that an index fund is the best option for beginners because you are diversifying the investment rather than just putting all eggs in one basket.
Investing tips.
Beware of scammers who tell you that they have a 100% way of making money in the stock market. Don't invest based on feelings and panic. For example, seeing a stock of a big company shooting up. Invest with logical reasoning and companies that you have an idea about. Don't sell the shares at a loss because the stock market is dropping down. Until you sell your shares, you haven't lost your money, but the stock lost value. Wait until it bounces back. Target stocks when they are at their lowest. For example, if a Tesla stock is losing value, buy them when it stops dropping down. Invest what you're willing to lose. Don't invest because people are telling you to invest. It might be a trap. They want you to invest to pump up the price of the stock and then they want to dump them for the profits. It is always safe to invest small money every month than buying shares with your whole pension, for example, because the price of shares changes over time. It might be expensive today, next month you might get the same number of shares for less. I know maybe not everything in this video makes sense, which is why you need to repeat some parts you didn't understand. I can also make another video to better explain some parts. I know that maybe you thought investing is very difficult. It's that simple. Now you have a clue about the stock market. What is left is for you to make moves because in investing the sooner the better.